Start. What happened to other kids? They went for their refreshments. I mean refreshments.
Yeah.
At what time you got the break for the last section? 3 o'clock. 3. What was selected? Statistics from MIs. Right. Okay, good afternoon. So we'll start the second part of our lecture. That's valuation plus the identification of trading price and all the things, right? Don't worry if you are not in the morning session, it's not difficult to catch the some components. So therefore you can identify some calculations while we are doing the calculations right now, right? So then we will go to the concept. Impact of interest rate on the bond prices, and then one sort of a relationship in between the bond prices as well as the other one. What is the interest rate, current interest rate? Therefore, take down the heading impact of interest rate on bond prices. Impact of interest rate on bond prices. Interest rate relationship with the bond prices. So what this concept trying to understand or trying to focus about, current market interest, right? So if you want to make a fixed deposit, if you want to open a fixed deposit, you can go to the bank and then deposit your money and open a fixed deposit. If you make a fixed deposit, definitely you will receive the interest, right? As well as you all know current market interest rate. What is the current market interest rate? Tell me. What is the current market interest rate? Rate? 10%? 7%? Sure. If you whatever the market interest rate, average interest rate? 7%. You are working at bank? Then you just predict it. Okay. Anyone else? Chalit. Chalit. Once I call Chalit, you can I can't just remember. Chalit, right? Okay. Morning going. You absent for the morning session. No, you absent for the morning session. You are Jayatiragan. Lanka. You are the person who just log into the session when I'm marking the attendance. Am I right? No. Only from the one girl is there, right? One girl was there when I'm doing the lectures in the morning session. Anyway, you didn't log into the sharp 8 or sharp 8:30, no? Yeah, sure. That means that is easy to catch the relationship and all the things, no? Hope you don't have any confusion in doing the calculation regarding bond values and all things. Did you do the calculation with me, Moni? Okay, right. Forget that. So one thing is, we know we have a current market interest rate, right? So what we are trying to analyze is, if we know current market interest rate is always changing, right? Last week it was 8 and this week it might be 7 and next week it might be 7.5 and likewise this is changing, right? It is changing. So this concept or else this section identify if the current market is the interest rate is changing, what is the impact of that interest rate on on prices or the bond valuation, or else is there a no relationship, or else what sort of an impact there is, right? That is what we are trying to analyze in this section, right? Okay, clear? So what is the impact of current market interest rate to the company's corporate bond valuation? To start with the discussion, we'll just start with our calculations first. Right. You can do the question number 7. Right? Question number 7. Read the question number 7. ABC PLC has issued, right, 5-year annual coupon bonds that pays 12% interest rate. 5-year, N equals 5. And then that pays coupon payment, how much? CR, coupon rate, that is 12. Face value 1000. Face value will be 1000. Question number 1. What it does? If yield requires for the investors, yield means return, right? Yield means equals to return. Similarly, other than around what it gives us. Return required for the investor, that means required rate of return, RRR, OR, is how much? If R is 13%, right? If R is 15%, if R is 20%, what would be the bond price? That means 3 different scenarios. What you need to do is you have to change the R, right? Change the R and then try to identify the 3 bond prices in these 3 incidents. Common conditions N equals 5. And then face value equals 1000. Coupon rate equals 12. That means 12%. Coupon payment equals 1000 multiplied by 12%. That means 120. We have 3 different phases. First case. Value B equals You know, coupon payment multiplied by 1 minus 1 plus interest rate to the power minus n divided by r. Plus face value divided by 1 plus r to the power. Then value equals coupon payment 120 multiplied by 1 minus 1 plus C R. In the first incident, R is how much? R equals 13%. Second scenario, required rate of return RRR or R equals 15%. Third scenario, RRR required rate of return equals, sometimes we call it as I also, that is 20%. 20%. That means here R is 0.13. To the power minus 5 divided by 0.13. Close bracket and then face value 1000 divided by 1 plus 0.13 to the power 5. Second case, value B equals 120, except required rate of return, other all information now constant. Multiplied by 1 minus 1 plus R, R means 0 point here, now 1.5. 1.5 to the power minus 5 divided by 0.15 plus 1000 divided by 0.15 plus 1 to the power 5. Third scenario. Value B equals 120 multiplied by 1 minus 1 plus 0.2 now to the power minus 5 divided by 0.20 plus 1000 divided by 1 plus 0.2 to the power 5. To the power 5. To the power 5. This should be to the power 5. To the power 5. The incidents. We have changed our first scenario, that is 13. Second scenario, that is 15. Third scenario, that is 20. Thank you.
Extension saves up to 300. Save to level 1. Mention 3,000. Yes, more subject side, yes. It's labor. Labor 2 seconds. And then this is communication for the second us this so okay.
Next day communication. You are targeting. Done? Right. So what is the first value? Hope you have got these answers. For the first one, that is 13% means the bond value is 964. Right? Then, if it is 50, your value is, bond value is 899. Third case, if your interest rate is 20%, your bond value is 759. Right? So now summarize the information. Summarize the information. Summarize the information. One side interest rate. Interest rate. Right? Interest rate. We have the incidence. Increase to 15 from 13 and increase to 20 from 50. What happened to bond prices? Bond prices? What happened to bond prices? If the interest rate increase, if the interest rate is increasing, what happened to the bond prices? Bond prices. Bond prices decreases. So therefore, we can graphically illustrate this one, 13%. Right? If it is 13%, the bond value is 964. And then if it is 15, the bond price is 899. And if it is 20, one price is 759. You can see very clearly here, if the bond prices are getting down, what happened? Interest rate are increasing. Actually, the interest rate is increasing or down, going down. So what happened? Bond prices decrease and increase. So we call this relationship as what? Inverse relationship, right? There is negative relationship, right? This is a negative relationship. Negative relationship between interest rate OR and bond prices. Bond prices. Bond prices. Right? You are going to write it again. Bond prices, right? This is a negative. That means interest rate increases. Interest rate increases. Bond price BP. Bond price decrease. Or interest rate decreases. Bond price increases. This is the first point. Second point, which sort of a relationship this is? This is a negative relationship. Negative. Negative relationship between interest rate and bond prices. Bond prices. Or this is an inverse relationship. Inverse relationship. You know, by looking at this inverse relationship, it's very clear. If the market interest rate changes, what happened? Definitely it is impacting for what? Impacting for the bond prices. This is actually a risk, right? This is actually a risk. Why? If the banks increases their current market interest rate, what happened? The bond issuers, right? The bond companies or the normal companies, PLCs, when they are raising funds via this bond, they have to decrease their prices or the market. What happened? Normally, banks increase their prices, increase their interest rate. Investors are not going to make the investment on bond. Why? They have a fixed amount of interest. That is a coupon pay. Just imagine coupon payment is 12. Right? Coupon payment is 12. But market interest rate, what happened? That is 20. It has been increased from 12 to 20. As a rational investor, what is the option that you are going to select? Are you going to make an investment on bond or else are you going to make an investment on bank or fixed deposit? You are shifting your funds, you are shifting your investment from the bond to what? To the bank side. So then what happened? Market price for the bonds are going down. Other way around, if the market prices are going down, banks are offering a lower rate, whereas coupon rate is high. Right? That means if you invest in a bond, you can have a 20%. Previously, what happened? Market interest 20 and the bond coupon rate is 20. What happened now? Market interest rate going down. Right? Market interest rate going down 20 to 10. What you are doing? You are taking your funds from the banks and then making the investment in where? Investment in the bonds. What happened? Bond prices are, demand is high. If you are shifting from the banks to the banks to the bond, what happened? Their demand is high. All are trying to make the investment on the bond. Their demand is high. Right? So then what happened? Prices are going up. Prices are going up. So this is actually happening at the market. Right? So actually, changing this interest, creating a negative impact for these bond prices. Therefore, we call this one as what? Interest rate risk. This is a interest rate risk for a bond prices, right? Interest rate risk. Okay. Hope actual scenario is clear to you. Are you clear on the actual scenario? If the banks are increasing their rates, bondholders try to move forward to the bank, so then demand is going down, price is going down, right? The other way around, if the bank interest rate are going down, investors are shifting from banks to the bonds. So then demand is high and then the prices are going up. Now we'll go to the next concept, that is identification of trading prices, right? Now take down the heading, bond trading prices. Bonds trading prices. Trading prices. on trading prices. To identify the concept behind this, we'll do the question number 8 and then back to the discussion, right? Same set of a question as previously, question similar to the question number 7, right? So we'll read it. DNP has issued 20-year annual, N equals 20 now, right? Annual coupon bonds that pay a 10% per annum coupon payment. That means CR is how much? 10%. You can calculate the CP directly. 1000 is face value multiplied by 10%. Coupon payment is 100. Face value is 1000. FB face value 1000. The market interest rate changes to 10. R changes to 10, starting from 10. And then R changes to 12. And then R changes to 8. R changes to 8. Same set of a question. You can use same formulas as well as same structure for that calculate the numbers for the question number 8. I will summarize the question with you all. Three different cases, but basic information similar. Value equals, now we know coupon payment is 100. CP calculated 1000 multiplied by 10%, that is 100. 1000 multiplied by in first case, interest is how much? Interest is 12%. 10%. How many years now? 20 years. 20 years. 1 minus 1 plus 0.1 to the power minus 20 divided by 0.1. Second case, value equals 100 multiplied by 1 plus 0. Is that 1 3? 1 3. Interest rate for the second case. Case. All right, so you can check whether your answers are correct or wrong. Right. In the first instance, question number 8.1, the bond value is 1,000. Right? If the interest rate changes to 12, bond price is, bond value is 859. And then last one, if R equals 8%, bond price is changing to 1,196. If you have any question, please tell.
Yeah.
Now we'll come to the conclusion. Right? We'll come to the conclusion. We had three scenarios. First one, two, and third one. All these three scenarios, coupon rate, is it going to be changed? No, right? Coupon rate is similar. 10. But yield rate means market interest rate. Market interest rate or required rate of return. Required rate of return. Required rate of return. First incident, that is 10, and then second incident, that is 12, third incident, that is 8%, but I have made it as an ordered manner, right? 8, 10, 12. First incident, coupon rate is higher than the market interest rate. Second incident, coupon rate is similar to the market interest rate. Third incident, coupon rate is lesser than the market interest rate. What this says, when you give the 10% return, banks will provide the 12% return. Right? 12% return. If it is so, we know face value for these three scenarios, 1,000, 1,000, 1,000, similar. Now, quickly mark the bond values here. Respective bond values, please mark in front of these three incidents. If you have the lecture notes, do it, or else if you do not have, please draw this chart and then write it. Tell me the answers. If it is similar, coupon rate and yield rate, definitely one price is 1,000. Please remember that one. Coupon rate and yield rate is similar, definitely face value and then the bond value is similar. Right? So we call that scenarios if at the market, if any point where the coupon rate is similar to the interest rate, definitely bonds real value might be the 1,000. We call this one as, at that point, it is trading at par value. Trading at par value. Right? Trading at par value. Second scenario, okay. First scenario, what is the price? 1,000, 1,000, 1,100, 96. Look at here. You offer 10% for your bonds, but banks offer only 8%. Right? What happened? Even the real worth of this paper is 1,000. If you want to buy this bond from the market at this time, definitely you have to buy by expensing more than 1,000. Right? We call it as a trading at premium. Trading at premium. Premium means face value is lesser than the bond value. Right? Third scenario, what is it? You offer 10%, but Market offers how much? Market offers 12%. 12%. What happened? If you are an investor, now you are shifting from the bonds to the banks. Why? They are giving us 12%. At that scenario, definitely your face value is higher than the bond value. According to your bond value is how much? 850. 850. We call at this point, right at this point, bonds are trading at which values? Discounted value. Or bonds are trading at discount. Right? Bonds are trading at discount. Three scenarios where the coupon rate is similar to the yield rate or the required rate of return. Second scenario, again, next scenario, if the coupon payment is higher than the bank's interest rate. Third scenario, if the bond rate is lesser than the bank interest rate, at that point, definitely bonds are trading at discount value. And then if the market interest rate is lesser than our coupon rate, definitely bonds are trading at premium values. Clear? Any unclear points here? Morning boy. What is your name? Patu. Clear? Raksa. Clear? Question number 9, you can answer. Another aspect, right? Another aspect, what is it? Yield rates, yield measures. Right? Write it down, yield measures. Yield measures. So we identified yield means what's a similar name? Similar name? If it is very unfamiliar to you all, yield, you heard the what is means by it. We don't know yield. Very good. What is it? Return. Yield means return. Subscript it. Return. What we are going to measure? Return. Right? What we are going to measure? Return from this investment. Return from this investment means again other way around, required rate of return for this investment. Right? Required rate of return for the investment. So we know if you invest in a bond, now this is discussing about the bond. Right? Bond. If Chalita, right? If Chalita invest in this bond for a Solomon company. What is the current yield? What is the current yield means? Today, at present, what will be your return? That is denoted by the current yield. First measure. Right? Second measure, yield to maturity. Yield to maturity or is substitute return to maturity. Right? Return to maturity. What is meant by return to maturity? If Charlie hold this investment until the maturity during these 5 years. If Charlie hold this investment until the maturity, what will be the return? Real return for Charlie is captured by who? Second measure, yield to maturity. We call it as YTM, yield to maturity, or else that is very simply return until the maturity. Returned until the maturity. So these are the two measures that we are going to discuss regarding the what? Clear? Okay, current yield. We discussed the first point, current yield. Current yield means what? Right now, present. Chalit invested in Solomon Company. Right? If he has invested in Solomon Company, and right now, just imagine now we are in 2026, 2027. What is its return? Just received return is what? Exactly what is it? Your coupon payment. Right? First year you received coupon payment. Second year also you receive another coupon. Third, fourth, and fifth year you receive not only the coupon but also the face value. If you have acquired that bond not for the face value, lesser than the face value, you can identify what? Capital gain also. Because why? You acquired it for 800, but you can have 1,000 at the end of the fifth year. 200 difference is there as a capital appreciation. That is not captured by current yield. Can we have it right now? No, you can't. What you can just have? What you can just have? Your coupon payment. Coupon payment. Right? Therefore, current yield calculation identifies current yield identifies coupon payment. Coupon payment. Just received coupon payment. Yield means you have to express it not in the amounts, it need to be expressed in relative figures in the ratios. Right? Now the capital just received coupon payment might be 100, 200 or whatever the amount. That is not in the numbers, it's in the amount. How can we convert this number into a percentage? You have to divide it by some amount. What should be the? When we are dividing means actually when we are considering about the return, you are earning this coupon payment for what? For which value? For which value? Okay. Face value. Any other answers? Right now, yes, intrinsic value. Intrinsic value sometimes it's similar to the actual value is you even the Chalit, when we are issuing this bond to Chalit, right? I said to you, sometime it might be issued at 1,000 face value. Or else sometime it might be higher or lower than the face value. Definitely, even you are not the first person of this bond, you have to acquire this from the market. Right? You have to acquire this from the market. Or else if you want to sell this one, you don't need to wait until the maturity. What you can do? These transactions are happening while the system while the Colombo Stock Exchange. So then whatever the point you want, you can sell this one to another one. That means current market. If you are purchasing it from the market, CSC, what you can do? That is the amount that you are sacrificing on behalf to acquire this one. On that amount, you are receiving what? You are receiving the coupon payment. Face value definitely at the end you will receive the face value. So therefore, it should be market value because you are going to acquire this bond from the market or sometime it might be the initial company. Definitely that value should be below or higher than the face value. right? Therefore, you acquire this market value. On behalf of that acquired value, you are receiving this much of a coupon payment. So this is the way how can we identify your current yield, present yield. Clear? You can write down the formula that has been mentioned. Forget about the bonds, just think it. So how can we identify a return? Return need to be considered with the sacrifice amount. Right? Sacrifice amount to acquire this bond is how much? The market price that you are sacrificing to purchase this bond. So therefore, in gaining the current yield, or the present yield or the present return, you have to consider coupon payment versus market bond price. Just coupon payment, just receive coupon payment divided by market value. Okay. Just do the given question. We go to the example. For example, if the bond has a 6% coupon rate, par value is 1000. Par value means Lakshita. Very good. What is it? Face value. Face value equal 1000. Right? Face value equal 1000. That face value is how much? 1000. Price? Real price? Market price is how much? 1010. Even the face value is 1000, market value is 1010. Can it be happen? Yes, it can be. Face value definitely at the end of the maturity. Sometimes it might be go to the 2000, 3000 again, 1000 again, 900 like that. During these 5 years, it might be changing. That's because of what? Because of definitely the interest rate as well as the other factors. We previously very clearly identified how the interest rate is impacting to change the bond prices. And then, okay, calculate current yield. Current yield. How can be? 1000 multiplied by 6%. What is that? Coupon payment, CP, 60. 60. We acquire this 60, or else to gain this 16 just now. What is the payment that you have done? 1000 or 1010? 1010, that is the price where you have to purchase this one. Face value means at the end, right? But you have to sacrifice 1010 to acquire this. If you acquire this bond 1010, immediately you can have how much? 60 rupees. So then, what is your current yield? 5.9. 5.94. Check the exact same answer. I just wrote. Anyway, advertisement. I have released your assignments. Have you seen that one? I just uploaded the around 11 or around 11:30, I have uploaded your group assignment in the LMS. You all can work on that. LMS PDF is there, group assignment and submission link also there. As I remember, submission deadline is 3rd April. Right? 3rd April. It's regarding the, okay, I will tell it. If you want, you can leave that one also. So it's regarding a video, right? So there were 3 topics, right? There are 3 topics. First topic is regarding the financial instruments, that means loan, bonds and all the things. And then the financial infrastructure. And then second one regarding the financial market. The third one is regarding the financial institutes and central bank duties. Right? So first you have to, so all of the members needed to be involved in this video, right? So you have to do the presentation or whatever the method you can apply. You can have an interview with the resource person and you can record those things and you can read your things, or else you can do a presentation and video it, whatever the method. Right? Since we have a 10 weeks to complete the 15 weeks, so I have decided to take your presentation in the mode of video. Then I don't need to waste my time on at the lecture hall to take out your presentation. I can do my lecture part. All the 15 weeks can be taken for the lectures. Then I will do my evaluations based on your group assignments, right? So you can upload that video to the LMS. Whatever the method you can do, but only the audio video, audio representation is not allowed. Some are doing the AI usage and not only the involvement of the individuals, they are giving the script to the ChatGPT or whatever the AI software, and they are downloading the videos. No, just the central bank is there and then voice is coming out. No one is involving explaining about the central bank, and then just the ChatGPT or voice is there regarding the central bank. Right? Your videos can't be like that. You have to explain about, or else, if for example, so there are, if your part is central bank, you are assigning a task. No, so then what you can do, you can meet up another person in central bank and you can have a discussion, small discussion, and that part can be added to your video. And next person is regarding the commercial bank. So then that person can have an interview with the commercial bank expertise in Sri Lanka and then take in the explanation from that person, and then that part can be added to that video. Likewise, you will have you can use different techniques to prepare these videos. But you have enough time now. Approximately how many months? 1 month and 1 week. So then this is the 4th week now. Then you can do your videos and then get ready with the report and then submit it to the LMS. Any requirements? Video එකක් කරලා ඔයාලට assign කරලා තියෙනවා areas ටික group 1 2 3 all the things are in the LMS. If you want, you can view it. Can you go there and view it? Yes. 3 to 6. Oh, 6 to 7?
7 is okay.
Okay. That means 2 groups or 3 groups?
3 groups.
I given the topics for 3 groups. That's why I asked. Is it there? Assignment? Download it. Submission එක ඇතුළේ තියෙනවා. Click on the link and then you can view the PDF. It's not there. No. You can go through the assignment and then if you have any questions, you can directly contact me. What very simply කරන්න තියෙන මොකද්ද? ඔයාලට assignment area එකෙන් video එකක් හදලා මොනවා හරි method එකකට හැමෝම involve වෙලා ඉන්න ඕන. හැමෝම involve වෙන්න ඕනේ. හැමෝගේ presentation participation තියෙනවා. තමයි evaluate කරන්න බෑනේ. So 20 marks will be allocated 10 marks for the group presentation and then the other one 10 marks for the your reports and all together 20 marks, right? Other than that one, 20 is going for the quizzes also. Hope to conduct the first quiz in next week. Can you do it? First quiz in next week and then after that one, we'll have the second quiz. So therefore, share the information with all the students from first lesson to the until the bond valuation, right? Bond valuation, time value of money, and then the first lesson. Okay. So now, yield to maturity, right? If you want a break, you can have a 5 minutes break and come, right? So that's the ending part of the lesson. Yield to maturity. If you want, you can have a refreshment or you can have a just refresh by drinking a water for a 5 minutes. Oh, going together. PDF එක නෑට මම අපේ අප්ඩේට් කරනකොට මේ අප්ලෝඩ් වෙලා නෑ මම අප්ලෝඩ් කරලා.
Coordinate In the main material for there, we also the money.
Okay. Okay. Great start. So here is your maturity, right? So next week I will give the quiz, right? 10 MCQs, right? 10 MCQs, 20 minutes, right? 20 minutes, 10 MCQs from first lesson to the one valuation. Means until the covering the yield maturity. Okay? MCQs means you might have the 4 answers via the LMS. Then you can give the correct answer, then automatically your marks comes. Have you done any quizzes previously? Familiar with it? Familiar. Hope you all are familiar with it. Conducting quizzes via the LMS. Okay. Calculations, you have to do the calculation and give the tick mark there, right? So if I want, normally what I'm doing is, I'm taking the calculation separately in another tube. You have to write the answers properly, the steps and all the things, and then that has to be scanned and uploaded to the LMS after the quiz as quiz workings. That's a normal way of doing the quiz in business finance subject, right? That means you can put the answers in the LMS. Meanwhile, you can do the calculation for the respective question one by one in order manner. So then that has to be at the end you can submit the quiz and then have the marks. Meanwhile, you can update the workings to the LMS. What I'm checking is the quiz workings, not your marks. Right? I will go through one by one quiz the workings and give the proper marks for the quiz workings. Right? So that means sometimes you might give even the correct answer, but the way how you have do the answer, the way how you have arrived that answer is not clear or it's not mentioned. So then sometimes that might become suddenly you have received that answer. There might be some scenarios, no? So then to make the proper standard, what I'm doing is I'm taking your workings in separately and then I'm evaluating your workings at the final tick mark quiz marks. Clear? Otherwise, sometimes not you all are not doing like one. You can take the help of ChatGPT and then put your quiz with them, put your quiz question in the ChatGPT and get the answers and all the things. So I know you are not doing that one, but there might be some cases, no? That's fine. Okay. That's for your betterment because MCQ means you are ready for the business finance examination. I hope you can understand the purpose of that one because even you are not practicing this business finance subjects, this is something new to you. Right? So then if you are not practicing means in semester definitely might be you have to at the end you have to ready for it from the 0 to percent. To avoid that one, I'm readying you one by one. That's why I'm giving first 5 weeks, one quiz, and then second quiz after another 5 weeks. So that means you can ready step by step. You can ready for the first lesson to the valuation lesson, right? Otherwise, you are not reading the papers. No, you are not reading whatever the notes that I have given to you at the end examination. You are searching all the things. You are searching the notes, and then that might be confusion at the examination. Okay, right. So back to the yield to maturity. If we cut the word yield to maturity, what is it? Return to maturity. Return to maturity means return to maturity. If the investor hold these investments, investment on where? Investment on bond, what would be the return? Entire period, what would be the return for this bond investment? Right? Or else the bondholder, if the bondholder holding this bond until the maturity, what is the return that he can earn from this investment is called as what? Yield to maturity. Yield to maturity. In considering this return would be coming in two different aspects. The first one is what? Return from the coupon payments. The other one that we have discussed, return from where? Return from the capital appreciation that might have at the maturity. In entire all together what it is? Both together, that is the return for this investment, where we call it as what? Yield to maturity. Yield to maturity. The way of calculating this yield to maturity, there are different ways of calculating the yield to maturity. But one of the easiest method is to calculate the IRR. Right? To calculate the IRR for this respective investment will give us, what would be the return at during this holding period. You know IRR. IRR denoted by where the NPV. And very good. NPV become 0. What would be the rate? Which rate? Discounted rate. Discounted rate means interest rate. No, even we are taking it as a discounted rate at the NPV valuation. Actually, what is that? That's a market interest rate. So that means in here also we are going to identify no profit, no loss. At what point you are going to bear, right? Again, at what point you are going to bear this, you are going to equal this, the sacrifice amount to the return. At that point, what would be a return rate, minimum return rate, right? That is what we call as yield to maturity. Darapu ganata samana wena thana market interest rate එක, minimum market interest rate එක කීයද කියන එකයි අපි බලන්නේ. So hope you are remember the way of calculating IRR. Right? Anyway, if you forget that one, you'll get back into the question and then have idea regarding the IRR. Okay. You can start the question. I will read the question. An investor purchased 5-year annual coupon bond that pays 6% per annum at 883.40 cents. Right? That means you go to the market and then you acquire a bond for which rate? 883. Now your sacrification, your current investment is how much? 883.40 cents. If you purchase this one, you might have two cash flows. What would be the future cash flows? Coupon payment from year 1 to year 5. That's the one cash flow. What is the other cash flow? At the end, maturity value or the face value 1000. That is another cash flow. Then hope it is clear the identification of two cash flows. But we were not given the discount rate. But we are trying to find out actually. That R is going to find out. Require rate of return for the investor. Right? So then if we are finding that IRR means you have to calculate the NPVs and two hypothetical discounted factors. Based on these two hypothetical discounted factors, you will identify at where all the present value of the cash outflows equals to the present value of the future cash inflows. Right? Therefore, you have to take two hypothetical discount rates here. Right? To calculate two NPVs. But it has YTN and then now we are going to start the IRR calculation. Here, right? First column, we need in calculating NPV, we have to calculate how many NPVs? Two NPVs, right? This is the NPV 1 and 5% discount rate. If you want, you can take 10%. That doesn't matter. Right? If you want, you can take the discount factor as 2%. Doesn't matter. You need only the two discount rates. This is NPV at 12% discount rate. Right? Two discount rates. In identifying these two discount rate, you have to identify properly the number of years. No? Number of years. How many years? Year 0. Sacrification. What is our sacrification? You have to acquire this from the market. That means you have to purchase this one first as an investor. You have to purchase this. If you purchase this one, what is sacrification? You have a cash outflow. How much is? 883.40 cents. That's your sacrification. Therefore, I have mentioned that one with the brackets. Cash inflow outflow. Cash outflow. Year 1 to year 5. What is the cash flow? I have a fixed amount of cash flow. What is that? Coupon payment. If I purchase this one, from the first year onwards, I will receive what? I will receive. Yes. If I purchase this, if Patu purchase this bond for 883.40 cents, from the first year onwards, you will receive Patu Lakshita coupon payments. Right? You will receive coupon payment. How much is it? 60. How can you arrive at 60? 1000 multiplied by 6. 60. Outflow or inflow to the investor? Let's say inflow plus. 50th. You receive the face value will occur the redemption, right? At the redemption point. So therefore, we have another name that might be called as the redemption price also. Redemption price definitely would be the face value. Or par value. Face value is how much? 1,000. Is that outflow or inflow? Outflow or inflow? Inflow. Why it is? You will receive cash back, right? The amount that you have given to the company is now going to settle that funds to us. And therefore, that is plus cash. Right? Then, first, NPV, calculation of NPV. First year, altogether we know 1. And then 4.53. How did I arrive this 4.53? Tell me. Working number and negative factor. Very good. Working number 1. If you want, that has not been mentioned, you can write it down. Working number 1. Working number 1. Working number 1. How can we calculate the annuity factor? Annuity factor? 1 minus 1 plus R. R here 0.05. Tentative amounts. We don't know actually what is the real required of return. That's what we are going to find here. To the power 5 minus 5. Divide by, very good, 0.05. What is the ratio? What is the rate? Calculate and tell me. Those who have not. Those who do not have the table, you can write it down. We have taken a new pen. This is pen is new. Your purchase t-shirts. What? You purchase. How many of you purchase then? Katum purchase. Who else? Three boys and 1 girl. Even the coordinator. Who is the boy coordinator? Hudson, no? There are 2 students from the HDB. Business Finance Release. Those 2 individuals are included in your assignment group list. You have shared me a group list now. Those 2 members are included in that group list. Aki. I thought Shaki. That's why I always complete Shaki. Now Shaki is not there. Katum has been. Okay, what's the answer? 4.33. Done. This is, if you want, please write it down. Working number 1. Refer the working number 1. Working number 2. Write it. Working number 2. Hope you all know the method of calculation. You all are counting students. So then working number 2. Working number 2. Right? Again, activity factor. If you want, you can write it down. This is activity factor. Activity factor at 12%. Activity factor at 12%. How can we calculate 1 minus 1 plus Rakshita 0.1 2 to the power minus 5 divided by 0.1. What's the answer? 3.6. 3.6. Then working number 4. Sorry, working number 3. 0.78. How did I take that one? 0.78. This is converting no future values into the present context. Right? That means working number 4. I will write it here. Working number 4. Very good. What is it? 1 divided by 1 plus R 0.05 into the power 5. Very good. To the power 5. To the power. Right? Working number. This is working number 3. Sorry. Working number 4. Working number 4. How can we arrive at one? Working number 4. Working number 4. 1 divided by 1 plus 0.12 to the power 5. The answer is 0.57. Okay. W1, W2, W3, W4. Now by taking these the discounted factors, you can multiply, right? This is discount factor and then A multiplied by B. The answer. If this is C, this is A multiplied by C. A C column, A B column. Right? 883 multiplied by 1 minus 883. 60 multiplied by 4.3, 259.74. 1000 multiplied by 78, that is 783. 2 inflows, 1 outflow. The discount, the NPVs, check whether it is 159. Check whether the answer is correct or wrong. 2 inflows, what those 2 inflows are, at 259 and 74 cents and then 783 together, the answer minus 883.40 cents. Check whether the NPV is 159 or not. And then 59.29.
Two workings are there. Then discount factor is 5. 0.7. We said this. Sponsor. Sponsor for today's topic. All right. Have you got the 159? 159. Okay. Sumudu, okay? Now, so then we put the second one. Second one. 1 multiplied by 883, that is 883.40 cents. 60 cash flow is 60, but discount factor is 300. Discount factor is 12, and accordingly annuity factor is 3.6. The cash flow is 216.24 cents. Cash flow is 1000, and then discount factor is 0.57. The discounted cash flow is 567. Check whether we have now positive cash flows, 2 positive and then 1 minus. Check whether you got the NPV for the second project is minus 100. Check whether the answer is correct or wrong. Okay. 100. Is that 100? Is that minus 100? No. Okay. Now we'll do the calculations for the IRR. Like IRR calculation. LDR. What is meant by LDR? Right? I have mentioned that one previously. What is it? Lowest discount rate. LDR is lowest discount rate. Then NPV at lowest discount rate. Which one is lowest? Which one is lowest? 5 or 12. That is 5. right? NPV at lowest discount rate is 159, right? But which one is highest discount rate? So then this is NPV at highest discount rate minus, right? Now look at IRR equals, which one is lowest discount rate? Lowest is 0.05. Don't get confused with the lowest discount rate versus FPV and lowest discount rate, right? Lowest discount rate is 0.05. Then, please remember, right? Don't take this part and add to this part and multiply that one with the difference. Here in after we are going to start a separate section. That's why I have taken another color. NPV at lowest discount rate is 159 divided by NPV at lowest discount rate minus NPV at highest discount rate, that is minus 100. Minus into minus what happens? Plus. Then take that answer and then multiply that answer with the difference with the lowest versus highest discount rate. Lowest is 0.12, highest is 0.12, lowest is 0.01. And lowest one. If you take here as decimals, please take it here as decimals. If it is not, if you just take it as a 5, please take it as 12 and 5. Otherwise, your answers are okay. Clear? Check whether what's your IRR. Take your answer and tell me what is your IRR. What's your IRR?
Nine
9.29. Okay. The last from the last. 2 girls. What's your NP? What's your IRR? 9.29. Rakshita? Kada. Sumudu. Okay. I'm waiting for the answer from Lakshmi. If after the quick thing complete, we can finish the part. So, Mudhu, what is the answer? Sure? You are discussing about that. What is your answer? What is the game then? Yeah. Person, please tell me. Yeah. Get that one. Right? So then, so what is this says? 9.2 or 9.3, what is this says? If bondholder keep this investment or bond until the maturity, the minimum return that he can earn is how much? 9.2. 9.2. Yeah, that's it. Any questions? No. So then we can find out. So we mark it as
Yes.